coverage of the FOMC's rate decision, and I'll just lay out what's going to happen. I'm going to summarize what the Fed did, the reasons behind it, some of the interesting questions that were asked at the press conference afterwards, but also at the end of this, you're going to be able to ask some questions. Teddy will come up and get some treats while you decide what questions to ask. And so that's the order of running. And obviously, if you're one of our supporters on YouTube or you do a super chat, you'll get pushed to the front of the queue for your question to be answered. So let's just run through the Fed rate decision, because I think the Fed has this habit of, usually there's a lot of consensus about what they do. There's not much dissent in the Fed, as in stark contrast to the United Kingdom, where the FOMC, the equivalent of the FOMC in the UK would be the Monetary Policy Committee, and there you do see dissent. So I think the US is interesting. Also, at the moment, obviously, what we're seeing is a lot of discussion about Fed independence and whether the Fed is truly independent and whether the new nominations from President Trump are going to maintain that independence. So obviously there are lots of questions about that in the press conference. But let's start off with the rate decision itself. Markets were pricing in a very high probability. I think the probability was 95% based on the Fed funds futures market. I looked at it this morning, 96% chance of a rate cut. And that's exactly what happened, right? So a 0.25% rate cut down to between 4 and 4.25%. That's the new Fed funds rate range. And they're going to carry on shrinking the size of their balance sheet by letting treasuries mature. So that's also obviously a more restrictive policy. That's trying to reduce the restrictiveness of that policy. And the reasons behind this were largely due to the labour market. Now, previously we saw pretty brisk labour market growth coming into this year. What we've seen over the course of this year is a real, very noticeable deceleration of job creation in the US. And usually that goes hand in hand with a weakening of growth. We haven't seen that weakening of growth yet, but the expectations are that we will see that. And then if we look at inflation, it is ticking upwards. A large part of that driver of upward inflation is not about wages now, it's about goods, and that's to do with tariffs. So what we're seeing is higher inflation due to tariffs, not a very large effect, it has to be said, and the question is how sticky that's going to be. Because if it is sticky, the Fed's going to have to slow down or even reverse its rate cuts. But at the moment, that looks pretty subdued. And in fact, if you look at the summary of economic projections, which we will in a sec, GDP growth has actually been revised up a shade. So we're not looking at a huge recession, at least that's not the central case. What we're looking at is growth which is pretty much okay, a labour market which is still has very low unemployment, so it's still pretty healthy, but it is slowing down, and that is a concern. And that's probably one of the reasons behind the Fed's rate cut this time around. They obviously have to consider whether cutting rates is going to overstimulate the economy and stimulate inflation. But certainly at the moment, despite the fact that inflation ticked up a bit, the latest print, they decided to cut rates. So job creation is a big part of it. The politics was a big part of it this time around, and that was a large part of the questions that were asked. So just as a reminder, let me just share this with you. The end of Powell's term as Fed chair is going to be May of next year. So that's going to happen. He's going to serve out his term, at least that's the expectation at the moment. But there are big questions about independence. So if you look at the vote this time around, you can see that Stephen Moran is the one who dissented. He wanted to have a cut of 0.5 percentage point. In other words, 2.25% cuts rather than the usual 0.25. Now that's the kind of thing you'd expect if there was significant weakening of the economy, but that's not what we see in the data. So it makes you think, well, why is he saying that? Well, remember that The president's also been trying to fire Lisa Cook based on some irregularities about her mortgage applications. However, he didn't manage to do that before this rate decision. Also, we've seen Stephen Moran appointed by Congress, and he tried to reassure Congress that he would be independent. So what's a little bit odd about that is that he's kept his job as chair of the White House Council of Economic Advisors. He's actually got an unpaid leave of absence from that job. So he's still got one foot in government while working at the supposedly independent Federal Reserve. Now that's a bit odd. It's unprecedented. And the one of the members of the committee, which was deciding whether to approve him for the role, this was a Democratic Senator, Jack Reed. He said, Trump can call you up in his capacity as president and say, I want you to do this. That is absolutely ridiculous. And I think that's potentially a good point. The second shocking thing, I think, which was said at that meeting in Washington was Stephen Moran's comment. He said that he didn't expect bond markets would balk at the potential loss of independence of the Federal Reserve. I beg to differ. I think if there was signs that the Federal Reserve was not independent, bond markets would go crazy. So having someone on the board of the Fed saying that is very worrying indeed. I don't anticipate the bond market saying that, Moran said, adding it was impossible to respond to a hypothetical. So anyway, he is now part of the Fed board. And there was a question about it at the FOMC press conference. The question was along the lines of, he's kept his job at the White House and he's joined the Fed board. This is the first time I believe the Fed board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And Powell's response, which must have been difficult to kind of pull together on the fly, but he said, so we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I don't really have anything to say. So he didn't really comment on it, but it is very odd. If we compare the Federal Reserve's policy with other central banks, you can see that the Federal Reserve here in yellow is now at the top of the pack. So we've now seen it cut to between 4 and 4.25%. This was as of this morning. So the Fed's line will come down a bit, roughly in line with where the Bank of England is at 4. Australia's down at 3.6, Canada's down at 2.75, and the euro area has been cutting like crazy. So really, when it comes to these cuts, the Fed has been the most cautious of all. So obviously this upset Trump because he wants rates to be much lower than they are today. If we look at the change in language between the Fed statement this time and last time, you can see the caution about the economy, which we didn't have last time. So for example, it says that job gains have slowed and the unemployment rate has edged up. And instead of the labour market conditions remain solid, it's very much changed that language towards a weakening of the jobs market. So its mandate for full employment is what probably drove the rate cut today. And it also says that the Fed judges that downside risks to employment have risen. So clearly the job market's a big concern now. And in the light of the shift in the balance of risks, the committee decided to lower the target for the Fed funds rate by 0.25 percentage point to between 4 and 4.25%. If we look down at the bottom, you can see the Fed member which left, which is Adriana Kugler, and you can see that Steve Moran here has been added to the list, and he was the dissenter who preferred to lower the target range for the federal funds rate by 0.5 percentage point at this meeting. So he was the dissenter. He wanted to cut more. Now let's look at that summary of economic projections, because it's always interesting. I'm going to move my face over here. Very good. So these are the so this is a kind of summary of what happened. I've put red boxes around the stuff I thought was interesting. So first, the GDP forecast. It's not really a forecast. This is what the Fed members expect. And these are the median from the dot plots, which are here, right? So every member of the committee who votes puts one dot on the chart, and then we look at the central case here. So that's the median. And we can compare the latest median with the one we saw in June. Notice how growth for 2025, 26, 27, all three of those have been revised upwards. And we've got a new forecast for 28, which is 1.8%, which is in line with the longer run expectations for US growth. That's a developed market, right? It's not going to have huge growth like EM. Unemployment rate, little bit lower, maybe. So 4.5 in June. Now they're expecting 4.4. 4.4 in June for 27. Now 4.3. And by 28, it's going to go to the longer run average, which is 4.2. Inflation, they expect to be a little bit higher. So 26, they expect it to be 0.2 percentage points higher. And then finally, the path for policy rates, they expect that to be lower than they did in June. So that's the overall pattern that we can see. The dot plots are kind of interesting. What we have seen is the path for the federal funds rate has been revised down. So the red is what you can see as the median in the latest meeting, and the black is what people expected in June. And certainly for 2025, it's moved down quite a bit. Overall, though, I mean, it's the same path that we saw previously. They expect it to be cut to the long run average, the neutral rate, if you like, by pretty much by 2027. And that hasn't changed hugely from the previous meeting in June. What's kind of interesting is this dot. Now, you can see that there is an outlier here. Who could it be? Now, maybe it's Stephen Moran because he's dovish. Maybe. I just don't know. But that's certainly a possibility. So now let's turn to the expectations that we had this morning. So every time we have one of these FOMC meetings in the morning, I look at the Fed funds future market and I look at what it's pricing in. Now you can see that each of these rows is one meeting. So there's one in September today. There's one in October, December. So two more meetings over the course of 2025. And the expectation is that we're going to have a cut, that we would have a cut today. The probability was 96%. A 75% of another cut in October, and almost 70% chance of a cut in December. So overall, a 0.75% cut from where we are, where we were this morning. So 3 cuts this year, including the one today, and then in 2026, markets are expecting another 3 cuts. So pretty aggressive expectations, probably more aggressive than the Fed itself. But remember that the Fed is expecting that the neutral rate would be something like 3. So that would be about here. But markets are expecting that we're going to end up slightly below that, possibly by the end of 2026. But still, the Fed did what markets expected, the Fed funds futures market expected at least, and it cut today. Balance sheet runoff, we're still seeing that. It's slowed down a bit, you can see. It's still chunky, so just under $7 trillion, but it's way below the $9 trillion we saw previously. So deceleration of that, maybe so that the market, the policy rate isn't as restrictive. If you slow down the rate of quantitative tightening, that's kind of like easing a little bit, or a rate cut. But yeah, overall, I'd say that the press conference was interesting because some of the questions were about politics. So let me just share some of those with you. a political Fed. So the question was, you've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as things they should be watching to determine that the Fed is still making decisions based on the economic outlook rather than political considerations? And Powell's reply was interesting. He said, it's deep in our culture to do our work based on the incoming data and never consider anything else. And anybody who's at the Fed really feels strongly about that. You'll know by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. In other words, all aspects of the Fed's actions and words will tell you that they are not politically motivated. They're motivated by what they consider to be best for the economy. He said, when you go to Washington, everything is seen through the lens of, does it help or hurt this political party or this politician? But at the Fed, that's not the way they think. They're taking a longer perspective, he said. We're trying to serve the American people as best we can. I don't believe we'll ever get to that place where we're a political Fed. But anyway, that was the overall response from Powell. He always refuses to comment on what politicians have said, what Trump has said, what Stephen Moran, who's now at the Fed, has said. There were questions about that, but he really refused to answer. He kind of ducked those questions. He really focused on the policy decision itself. A big question is whether we're going to get pass-through inflation. So, okay, inflation's ticked up slightly. It's due to goods inflation, largely that upward tick. And the question really is, will that be sticky? Is it going to get worse? And this is a question about pass-through inflation. So let's say you're an importer. It's the importers which have been paying the tariffs to the Treasury. But the question is, will those importers pass on those increases in cost, those tariffs, those taxes on imports to their customers? And then we'll see it in the inflation numbers. And what Powell said is that these companies have been taking a hit so far, partially. So largely the kind of impact of tariffs has been on the margins of those companies. But what he said is that the companies that import have every intention of passing that through in time, but they're not doing that now. So they're going to pass it through to the consumer eventually. The pass-through has been pretty small so far. It's been slower and later than expected, but the evidence is very clear that there's going to be some pass-through at some point. So clearly the Fed's thinking is that, yeah, it's going to happen. We're going to see inflation tick up further, and it could be transitory. He didn't use that word, but it could be transitory as long as people don't anchor their expectations higher for inflation. So that's what they're watching really carefully, especially now that they've cut the rates. There were questions about data quality. There were questions about Powell did talk about cuts at the Fed. They haven't increased the headcount at the Fed for about 10 years, he said. It's been constant over that period. There will be some layoffs at the Fed, as there have been across the entire US government. He didn't comment, I don't think, on the firing of the head of the Bureau of Labor Statistics, which produces the jobs numbers. That's Erica McIntyre, say it properly. She was appointed by Joe Biden. Very clear that she wasn't politically motivated, or that she had much role in talking about the non-farm payrolls numbers, which we'll have a quick look at. So this is what I'm talking about. So this was the non-farm payrolls. So you can see that after 2023, we had huge numbers. It was averaging about 200,000 new jobs created for the US economy. And then it fell gradually. And now it's fallen quickly. And in fact, we had a negative jobs print 3 prints ago. So pretty weak job creation. Now that we've got less immigration, again due to President Trump's policies, the neutral rate to absorb new entrants is about 50,000 new jobs a month. And what we're seeing is probably below that. And if it goes into negative territory, then obviously you see unemployment start to tick upwards. But what we saw after the recent revisions, which were really quite brutal at the beginning of August, was that Trump did this firing of the Bureau of Labour Statistics, which was quite shocking, quite shockingly bad. Because what it feels like now is that if there is bad data, the president's going to fire people who produce that bad data. So every time they publish a data point, there will be a strong incentive to keep their job and not give bad data, to manipulate the data to make the president look good, which is sort of EM territory, right? This is like this is behavior you'd see in emerging markets, not what you'd expect to see in the largest economy in the world. So that kind of thing, not trusting the data, weakening of independence of the Fed, all of this is worrying. So it's not entirely surprising, given that we've also got a fiscal deficit of about 6% in the United States and debt to GDP ratios increasing and very little regard to reducing that. It's not altogether surprising that what we've seen is the long end of the yield curve moving upwards at the same time that the Fed is cutting rates. And what we've seen is a steepening of the yield curve as a result. So all of these things are feeding into a market which I think is getting more concerned about what's going on politically. Concerns on the labour market. If that continues weakening, we could see weakening of growth. It is usually an early warning sign that growth will weaken when we see jobs weaken in that way, the jobs market weaken in that way. If we can trust the data now, that's not altogether clear. So Trump's actual statement when he fired McIntyre was, "She'll be replaced with someone much more competent and qualified." She'd actually been working there for 20 years. She was very well qualified. Important numbers like this must be fair and accurate. They can't be manipulated for political purposes. The fact is, the way these non-farm payrolls work is that you retrospectively revise them up and down because you publish them in order to be timely before all the data from the survey is available. So naturally, if you do that, once all the data is in, you revise the previous numbers. So you've got a choice here. Do you want something which is timely, which gets revised? Or do you want something with a larger lag where you have to wait for everyone in the survey to respond before you publish the numbers? And what the BLS does, which they've fine-tuned over many decades, is they produce this timely number which is potentially inaccurate, which then gets revised for the previous 2 or 3 numbers. And it was that revision downwards which shocked markets and which also angered Trump. But you know, what's he saying? If someone else is in charge, you'll still get numbers which reflect what's going on in the labour market. So the head of the BLS is kind of irrelevant. So firing them was just ridiculous. Anyway, enough of that rant. Let me switch over to your questions. And we won't go on too long because it's quite late here in the UK due to partially the time zone difference for this time of year, because the UK and the US are slightly out of sync at the moment. But anyway, let's summon Teddy up the stairs, and I'll get his snacks ready. So I've got his burger. It smells so good, these. I wouldn't mind a nibble of that myself. Here he comes. I can hear the paws. Ted! Treat! Oh yeah, here he is. Very good. Oh, he's going to come up. Yes. There we go. That's one. Oi! You're going to nick them off the desk. I can't believe it. That is very rude. So yeah, please do ask a question. Please do like. Please do subscribe if you haven't, so you don't miss our future content. I've been recording lots of videos this week. I did one on the NASDAQ index. I did one on, oh, here we go. I did one, oh, Ted, that good. One more. Oh, he's got it, and he's going to go down for his biltong now. Biltong? She's got biltong. Laura's had to dip into her personal supply. She usually has Teddy biltong and Laura biltong. But today, because she forgot to get his, he's going to be dipping into her special supply of biltong. That's the kind of sacrifice we make at PensionCraft. Brilliant. So hopefully that's given you a chance to think about some questions, and we'll answer them. By the way, this is my new camera. This is my Sony camera, which is actually quite good. I'm quite happy with it. Although sometimes it does randomly stop recording. When I was recording a video today, I looked at one of the recordings and it just froze because OBS for some reason had stopped reading in from the camera. But anyway, hopefully that's going to be okay eventually. So yes, please do ask a super chat if you have a question, and we'll answer your questions first. Potentially we'll get through to the other people who haven't done a super chat to answer your questions. And if you support us on YouTube also, we'll push you to the front of the queue. So please do a super chat and I'll answer your question immediately. So one of our supporters on YouTube has asked a question. Thank you, Johnny. Johnny says, what's cheap at the moment compared to mean? Mean. I wonder what that means. What's cheap at the moment compared to mean? Any country stand out? I'm not sure I understand that question. Let's see if I can find it on here. Thank you for supporting our channel. Supporting our mean. Yeah, can't see it. Can't see it on the list. I'm not sure what you mean by that question. Oh, here we go. What's cheap at the moment compared to their mean? Oh, I see. Okay. Any countries or sectors stand out? Thank you, Laura. Okay, Laura just changed it. Okay, well, let's have a look at that. We have something specifically for that in our trackers. So if you join our community, you get these really quite cool trackers. I've just modified them again today, made the bonds a bit funkier. Let me see if I can share. Yes, I can. Good. So this is what it looks like. So these are our trackers, lots of different ones. But your question's about valuation. So let's look at Schiller Cape by country. So what I do here is I look at the Cape ratio for every country and compare it to its own history. So if the number's 94%, it means it's been cheaper. The cyclically adjusted price to earnings ratio has been cheaper 94% of the time. So this is a very expensive country. And that's Taiwan, which is primarily driven, of course, by TSMC, the semiconductor producer, which produces the chips for NVIDIA. So this is really an AI story about expensiveness. Over here as well, 92%, the 92nd percentile of expensiveness is the US. So US very expensive. India's at the 88th percentile. Netherlands is expensive. Australia's expensive. Germany, Canada. And then we get to kind of not so expensive. The UK's on its 61st percentile, so not particularly cheap, not particularly expensive. Countries which are cheap are generally in EM. Japan also. Although Japan is actually compared with its crazy valuations during the 1980s, so which make it look cheaper than you might expect. Mexico looks cheap, Turkey, Brazil, and of course China now not so cheap, interestingly, based on this measure. So this tells you what's cheap, what's not. Certainly if you look at the US market as well, it's still the case, I believe, that let me just make that smaller, move that over here, one sec. Yeah, if we look at Yardeni and we have a look at the US market, it's kind of interesting. Yardeni. Here we go. And what we'll look at are the different market cap valuations. So we'll look at the small caps, large caps, and so on. So what have we got? The indices, forward earnings. Thank you, Eddie Ardeni, for these graphs. They're brilliant. Forward revenue, forward earnings, forward PE ratio. This is what we're after. So the expensive one, this is relative. Oh, I don't want that. Forward earnings, profit margin, forward PE, that's what I want. So the expensive bit of the market are the large caps. So the S&P 500 valuation here is at 22 times forward earnings. That's pretty much where it was during the peak of the euphoria after the pandemic sell-off. So briefly markets became cheap in the US, then they became super expensive as we had this flight to shite, as people call it, a junk rally, and everything rallied and growth went crazy. And funds like ARK-K went through the roof, as did Scottish Mortgage in the UK, as growth stocks just went bonkers. Then we had the kind of tech wreck in 2022 when valuations came back to something more average. But now we've seen the euphoria return in full flow, despite everything, despite tariffs, despite weakening of the Federal Reserve's independence, despite a deficit, a fiscal deficit of 6%, which is growing the debt to GDP in the US. All of that completely seen through by the market, not a problem, apparently. So things are very much priced to perfection for the large caps. Oh, but look down here, what's this? These are the mid caps and small caps. So the less risky of those, remember, are the mid caps. So maybe the play here is to buy those mid caps, which are not so risky as small caps if the economy weakens. Because remember, if the economy does weaken, small caps usually suffer the most. The mid caps have probably got larger balance sheets and can weather it a bit better, and are equally cheap as the small caps. So maybe that's the way to play this. Personally, I bought a small cap tracker a while ago. I think it was last year, quite early last year. And it has rallied a bit. I've lost money on currency because the dollar's weakened versus sterling. But still, I have made some money on that. But maybe I should have bought mid caps. I don't know. What do you think? What do you think I should have done? But the valuations for those two, 16.2 times for the mid caps and 15.6 times forward earnings for the small caps. So that's another way of looking at global markets. Break it down by market cap, and mid caps, small caps look pretty cheap in the US. There we go. So hopefully that answers your question. But in terms of countries, yeah, largely EM. That's relatively cheap at the moment. We could look at MSCI as well, but that's telling quite a similar story as the CAPE ratios. Yeah, let's have a quick look at that. It's kind of interesting. So this is Ed Yardeni stuff again. So let me just get rid of that. So what looks cheap, obviously, is emerging markets, except for India, which is very expensive. And what's looking expensive is the US here at the top. And the All Country World Index is at 19.4. The US is at 23 times forward earnings up here. Countries that are cheap, let's move down to what's looking cheap. Yeah, UK 12.9 times forward earnings, that's pretty cheap. But the UK is usually cheap, right? That's a problem. And that's why I compare countries with a CAPE ratio with their own history. Because some countries are always cheap, they're just not popular. What else is cheap? Canada, probably. Any kind of North American stock which is outside the US broadly is cheap. Germany, 14.5 times forward earnings. But then if we come down to EM, Spain probably, yeah. So Spain, 12.2 times, Italy, 12.3. France pretty expensive given all the debt worries about France at the moment, with the debt to GDP being high and a pretty chunky deficit and all the political crises around that. They really need a big structural reform. They just need to spend less, but it's not going to be popular with the government. So we see governments collapse fairly regularly there as a result. But valuations still look pretty high for their stock market, considering that. What else is cheap? LATAM, yeah, cheap. Brazil, 8.7, very cheap. India, 22.6, incredibly expensive. And China, 13.4, so still looking pretty cheap at the moment. So that's China getting less cheap, it has to be said. It has risen quite sharply recently, whereas Brazil is pretty much still in the doldrums at 8.7 times forward earnings. So, if you're feeling brave, these are the things on the menu: Indonesia, Korea. But remember, all of these things are cheap for a reason, and that's always the difficult thing. If you want to be contrarian, you have to buy something where the story is bad. There are good reasons why people shun that market. So you have to believe in the turnaround, and you have to be patient. It may be that these things are in the doldrums for years. It doesn't always work if you buy a cheap country, because it can stay cheap if the reasons why it's cheap don't go away. So those are probably the considerations. I just be careful, if you are a contrarian, you've also got to be very patient. Next question is a super chat from Philip C. Thank you very much, Philip. He says, do you think we could see another 2008 crisis? Yeah, I think we could. I think at the moment, what we see in the investment grade space, if you look at an investment grade fund like LQD, is a lot of the bonds in the investment grade category, which are bought by a very large ETF like LQD, which is the investment grade iShares fund. And iShares is great because you can dig into the holdings and kind of break them down. So if we break it down by credit quality, take a look at the ratings here. So anything below triple B is considered junk. So very little. It's only the stuff that would have been recently downgraded before it was sold that would fall into that category. But you can see that there's a lot in the triple B category, which is the lowest rating, one notch above junk. Single A makes up 50% and triple B makes up 44%. So if there was some kind of thing which had a credit deterioration in the United States, it could be an economic shock, it could be due to the tariffs or some other policy which is going to damage the economy, well, that could weaken the balance sheets of these triple B rated companies, and we could start to see this kind of downward spiral. The difficulty with credit, I think, is that it exists in two states. A kind of quiescent state, it's a bit like a dragon, right? A bit like Smaug. Smaug sleeps most of the time. So does Teddy, my dog. But sometimes he wakes up and you better run if that happens. Well, the credit market is very much like that. It's in a quiescent state at the moment. Credit spreads are absolutely tiny. So you're not being compensated for any risk. If defaults do increase, you're not being compensated for that. Because like the equity market, it's priced to perfection. But if there is a shock, I think we could start to see this kind of downward spiral. And we could start to see a cycle of downgrades, and then credit spreads widen. People worry about who's next to be downgraded, and then you get these kind of default storms, if you like. So, yeah, I think that's a real problem, which could occur given current policies. But look, at the moment, everything's fine. That's got to be said. The US economy is okay. Unemployment's fairly low. Credit card delinquencies are increasing a bit. But there isn't a crisis at the moment. We're far from it. And we're not pricing it in as well. So let's just hope it doesn't happen, because markets really are priced as if everything is absolutely wonderful. Just beaming grins all around from risky assets, which is always worrying. It always reminds me of 2007, It took so long for equity markets to realize there was a problem. You know, by the time they'd fired the entire ABS desk, asset-backed security desk, which is a form of credit, they'd fired the entire desk, the CDS market, the credit default swap market, the CDO market had imploded. And it took so long for the equity markets to finally realize, oh, there's a problem. And then they sold off. But it just reminds me of that. You know, equity markets have this kind of rictus of joy, which is always on their face. And it's only if things are obviously terrible that they kind of capitulate. But, you know, at the moment, everything's fine. So yeah, I'm worried. I mean, I'm not selling or anything. You know, I've still got my full allocation to equity. You know, my core, and then I've got my fund portfolio, which has got quite a bit of cash in it. So that should be said, actually. My fund portfolio, I have more than half of that is currently in cash, and that's 10% of my overall holdings. So if there is a big sell-off, I will buy using that money. But at the moment, I'm being very cautious with my fund portfolio. Not much fun at all. But, you know, it's earning 4%. So that's pretty good. Daniel Cooper, super chat, thank you very much. He says, US small cap value was up 2.5% around 2 p.m. US time. By 2:52, it was around minus 0.5. It did stabilize later. What exactly happened in this moment? Well, I suppose it's to do with the Fed, right? It could be around currency. I don't know if you were looking at the currency version of it. I mean, we could look at a US small cap index. I'm trying to think if I know one off the top of my head. Let's find one. ETF. Let's get the largest US small cap ETF. So what is that? So that'll be something like IJR would be one of them, or something that tracks the S&P 600, SPSM maybe. So let's look at IJR and see what happened today. IJR. Is that the one? iShares S&P 600 small cap tracker. Okay, so let's have a look at that. Year to date. We'll zoom in. Oh yeah, there was a wobble. Now that's volatility, right? This one is priced in dollars, so it's not a currency effect. Let's also look at the dollar. GBP USD. And zoom in today. Yeah, so you can see the same kind of pattern in sterling versus the dollar. So a very brief strengthening. Let's look at the timestamps here. So I guess that's the Fed announcement. Is that 6 o'clock? I don't know if that's UK time, because 7 o'clock is when the Fed announced and gave the policy announcement, and then 7:30 was a press conference, which is here. So it looks like we had a massive strengthening of sterling versus the dollar. So the dollar weakened a lot, and then it strengthened again, leading up to the actual policy announcement, which was a rate cut at 7 o'clock. So remember, a rate cut usually weakens the dollar, and this kind of just confirmed the rate cut, I think. So that's what the currency effect was. Small caps, difficult to say. I mean, clearly they're rate sensitive, so a cut is going to be good for them. So if we go back to IJR, I think we see a very similar pattern there, don't we? Yeah. So this is really about rates, right? So rate cut, good for small caps. Maybe they were expecting that it would be even higher. I don't know. That's maybe why it rallied. Maybe they expected a 0.5% cut, but then it was actually a 0.25. Hard to say. But yeah, I would expect those small caps to be very rate sensitive because it has lots of banks in it and a lot of loans to commercial real estate. So again, a very rate sensitive sector indirectly for small caps in the US. I think that's probably what's going on. So that's just rates being priced in, and a larger cut was expected initially, then it wasn't materializing, would be my guess. But you know, one day moves, who knows? Very difficult to guess. One more. Oh no, we've got more super chats. Okay. Johnny says, if the US market was to decline, what region would likely take up increased percentage of global index? Oh, good question. EM is the question mark. I guess if US crashes, everything falls. That's true. But it's a really good point, which is what will happen to the US? Who will take the baton of larger market cap? And I think that's kind of interesting point. Let me see if I can find this graph for you. There's a beautiful graph. Actually, it was taken from a publication by UBS, which talked about the size of the US market. Let's see if I can find it. UBS Global Wealth Report 2025. Is this the one? Hopefully I can find this graph, but it was just a beautiful graph which showed the historical size of the US market relative to the rest of the world. But of course I can't find it right now. That's the trouble with doing this stuff on the fly. What was it? It was US market cap. Maybe I can find it. Nope, I can't. Maybe it's in this one. No. Maybe it's in this explainer text. I use this graph a lot, so I'm bound to be able to find it somewhere. Here we go. Yeah, good. So this is the text of one of our explainers. Every week, our members, our community, vote, and I do an explainer video based on what they vote on. And it's great because I'm in sync with what my community wants, and they get what they like, and it's relevant by definition. And whatever gets the most votes, I make a video about that. And I've learnt so much preparing stuff for these explainers over the years. We've got over 100 of them, over 200 now, I think, of these 10-minute explainers, sometimes a bit longer, because I'm quite an old gas bag. Anyway, this is the graph I was thinking of. Let's just fit that to the page so it looks a bit bigger. So this shows you the market cap of the US and other countries over time. So the US is in red, and you can see that pretty much since 1930 it's made up between 50 and 75% of global equity. Sometimes it doesn't. And if you notice this period when Japan had incredibly high valuations, it had an incredible rally in property, in equity markets, and the market cap just ballooned temporarily. It was a one-way trip. It was a round trip to success, unfortunately. And then it kind of did the return journey around the 2000s when it imploded. But it was Japan that time around. Who would it be this time? That's an interesting question. I think Europe is still really struggling and has real structural problems. Could it be India? If you see the rate at which India, them equity markets improving, if they did manage to get structural reforms in India and manage to increase productivity and reduce waste and all the other things which would help their economy, maybe that could be India, which could grow very significantly. But is that going to happen rapidly? I doubt that. These kind of changes for EM usually take many years. But who would have guessed Japan could grow so much relative to equity markets elsewhere? That was a huge surprise. And so maybe it'll be someone we just absolutely don't guess would be possible to grow to that extent. Maybe there'll be some technical innovation, some technological innovation in a country, and they'll just balloon. But my guess, maybe India. maybe. But more likely, I'd say it would be China. Yeah, I think China would be more likely to take the crown because it's already kind of climbing up the kind of wealth creation scale. If they manage to keep their politics stable, which is a big if, and they don't decide to go head to head with the West and the US, which would I think that'd be a huge mistake for everyone. But if they did manage to just plod on at the rate of progress which they've currently got, I think it could be China. That's probably more likely than India. But probably not over my lifetime. BLH Low, nice to have a super chat. Thank you very much. One of our regulars. I always like to see the familiar faces. They say, oh no, super chat. Why is there shorting on CSH2? I allow securities lending on my platform and my CSH2 holdings have been lent out. Yeah, that is a bit weird. The reason why I say that is because if you look at CSH2, if you're not aware, this is a money market fund. Let's see if I can find it. Okay. So look at the shape of CSH2's. So what I've done here is I've plotted it versus MSCI World accidentally. So the blue line is MSCI World. Obviously that goes up a lot. It's a log plot. It goes up even more if it's not. And the black line is CSH2. So why would you ever short this? It seems kind of crazy. Because if you do short it, you're almost guaranteed to make a loss unless you think that it's about to not be going up. Maybe that's the reason. Could be derivatives. Maybe people are... because remember what happens if you have derivatives on an ETF, then the market maker, depending on the position, whether it's a call option or a put option, may have to short the stock in order to hedge their position. So if they've sold a call option, then the person they've sold to is long, the market maker is short, and they have to buy some stock. If they've sold a put option, then the person they've sold the put option to is short, the market maker is long, and then they have to short the stock. So maybe people have been buying put options on this. I don't know. It would be a weird thing to do, to buy put options on CSH2. But there may be other reasons for the stock lending which I haven't thought of. Maybe that's the reason. But if there are derivatives, then I would expect that there would be a market to do that. I doubt there's a lot of open interest in shorting that because it's unlikely to move a long distance in any direction. It does have fairly large volatility. If you zoom in day to day, you do get little bumps and lumps for the black line, but not huge, it has to be said, compared to MSCI World, for example. If I take MSCI World off so that we can zoom in properly on the line, yeah, I mean, there are blips, but would I short that? No. So I don't think that's the reason, but I'm not sure is the answer. Sorry about that. Next question's from Larry, super chat. Thank you, Larry. Last one, let's say, because it's getting late. Would you say Bitcoin is mostly a speculative index? Friends of mine are working in the crypto space, red team, none of them holding any crypto still. Okay. It's funny. I did speak to someone who was a founder of a big crypto platform. I can't say who it was. And I said to them, do you own any crypto yourself? He said, no. That was interesting. But your friends also say, why should I? All bubble? I'm currently really confused as tech people seem to steer away from crypto, saying it's all circle jerk. And on the other hand, mainstream picking up, highly confused. Is it speculative? Yeah. If it has a volatility that high, then clearly it's speculative. And let me just trot out my NASDAQ graph. This one always upsets. crypto people, because what I tried to do was do 3 times Nasdaq versus 3 times Nasdaq versus Bitcoin. So hopefully this will generate a graph eventually. It's just getting some data from the data source. Let me just share my screen again. So hopefully what's going to appear here. So what I do is I take the Nasdaq 100, I work out its daily returns, and then I multiply them by 3 as if we had a 3 times Nasdaq daily index. And then I compare the cumulative return on that versus what we get with Bitcoin. Is that going to work? No. Okay, there's a problem. Is there a problem with 3 times Nasdaq? Yeah. One sec. Did it get the series? Yes. So the series is there. I can't decode on the fly, I'm sorry. We've got NAs, that's the problem. So that should have no missing values in it. That's more like it. Here we go. So what we have here is that 3 times Nasdaq daily return versus Bitcoin, and the two track each other, not perfectly, but pretty well. It depends on the period you use. Clearly the returns on Bitcoin have been crazily high, but have slowed down because it is maturing. So that's exactly what you'd expect. And if we look at the more recent data, this is what it looks like. A pretty close match since 2023. And what's the reason for that? Well, the same people who buy growth stocks like Tesla, like Nvidia, are the ones which buy Bitcoin. So it's really driven by euphoria. It has no fundamental value. What is the value of something that pays you no cash flows ever? Well, it's whatever people are willing to pay you. It's purely driven by euphoria, or a circle jerk, as your friends said. So as long as you can find a willing buyer, yes, it's going to have value, but scarcity, remember, is not intrinsically something which creates value. It's people and psychology and narrative that makes value. And I think if we had a huge crisis, you can see what happened whenever there's a big sell-off in the Nasdaq. Does Bitcoin provide safety? No, it sells off as well. And that's why there's this high correlation. So yeah, I'm not convinced that it's a safe investment. There is more institutional buy-in, you're right. What is good is that you can now buy it in the UK. It's about to be the case that you can buy it through exchange traded notes, because those are, I'd say, safer. There is some counterparty risk from the issuer if it's an exchange traded note, but this is about to be introduced in the UK, by the way. I don't think it is yet, in October, I think. So you won't have to go to one of these Bitcoin exchanges, one of these crypto exchanges, to buy Bitcoin. It's very poorly regulated, that market. Whereas if you buy an ETN, at least you know that the issuer is regulated, the FCA's on it, so they'll try and avoid crises. So I'd say that's safer than buying via an exchange. And I probably will stop buying cryptocurrency in my fund portfolio via an exchange at that point. I'll just buy one of these ETNs. Although those have their own issues as well, which I think we covered in a recent podcast, Many Happy Returns, which I haven't mentioned yet. So let's have a look at that. Many Happy Returns podcast. Let me just quickly find it. Here we go. The latest one is about gold and why it's a terrible investment. So that's kind of similar to crypto in the sense that it's a wasting asset. It doesn't generate cash flows. It's only worth what people are willing to pay for it. Doesn't have many industrial uses either. But we try and make the case, at least I did, and Michael played devil's advocate. I tried to make the case that you should own it, and I think there is a case for it. But I think we did crypto. Here we go. So the FCA lifts the ban. UK investors can buy crypto ETNs, but should you? So there's a whole episode of Many Happy Returns, and you can find that on YouTube as well, incidentally, but also on Spotify and Apple Podcasts. So back to your questions, and I think that was the last one. Yeah. So let's stop there. Thank you all for joining us. We will be doing this again tomorrow, and the time for that will be 6 o'clock tomorrow. So 6 o'clock UK time tomorrow. I'll do this for the Bank of England, and I'll be watching the Bank of England and prepping for it for a couple of hours before the actual live stream. So I'm going to do this for them too. So please do join us then if you're interested in the Bank of England. And thank you for joining us this evening. Thank you for your super chats. Thank you for your support. And good luck with your portfolios.